All right. Hey, good morning, everybody. Welcome. Thank you for joining. I'm sure that more people will be joining. Um, Hold on, I'm getting some texts. I don't think the link came to anyone. Well, apparently it did because lots of you guys are on here. So we'll reach out to that person and find out if they're gonna if they'll be able to get on or not. All right, so let's just jump right into it. Let's start with what the report said, and let's get a good handle on what the USDA says our carryout is doing, and then we'll play with those numbers just a little bit, and then we're going to look at how the market reacted to it, because we've got a lot of really fascinating things happening here. So again, we've been looking at this spreadsheet for several weeks. This is your important line, right? This is your ending stocks. This is the carry out. And again, this goes from the marketing year that starts on September 1st of this year and goes through August 31 of next year. So we're dealing with next year's crop here and how many bushels we're going to have left over. So for context, 2.6 has been our carryout pretty much consistently from 2016 forward. We had a dip down in 2019 when we had, because of the planting issues and our yield was down. We just ended up with a lower carryout of about 1.8. So, but now we're right back to where we originally were. So in August, what the USDA said is our yield was going to come up to 181.8 and that we're going to grow a massive crop, right? And they also increased our usage. And we don't know if that's because exports were super strong or because we're going to feed more or we're going to grind more in ethanol. Kind of all of them went up, and they can choose to push those bushels from bucket to bucket as they see fit. We don't really know where that's going to line up. But what's interesting is that our carryout went up. Now, at the same time, we had the storm that went through. So the best that I can tell on the massive storm that went through Iowa is that there were about 60% of the acres planted to the corn and soybeans were impacted. It's hard to get a concrete idea of exactly what the damage was, but I think the midpoint of everything that I've read about it is that 8.5 million acres of corn were damaged. 3.5 were damaged critically, and so I think what that means is that what the USDA will do. There's two buckets here that they can push, right? So if corn was damaged, they can either decrease the yield per acre nationally, or we can decrease harvested acres. Every year we lose acres to silage and crop loss, all those kinds of things, and they build in a fudge factor, right? So I don't know how many of those acres they'll be able to slide into that bucket, but let's just assume that 3 million of the 15.5 million acres total that were impacted, and almost 9 of corn specifically, let's just assume that the net aggregate loss of all of those issues is equivalent to losing 3 million acres of um, of harvested ground. If that happens, then our carryout drops to a low 2. So that puts us at a lower carryout number than what we've been having at 2.6. Okay, so now let's play another what if game. The stock market has made a full recovery, right? We've now taken out the old high that was set pre-COVID. So if the stock market is trading at pre-COVID levels, then is it reasonable to assume that things like ethanol will also return to pre-COVID levels because people are aggressive? And if they do, then what happens to this end use number? And what if China buys? you can hear what I'm doing, right? We're shifting the narrative in the broader market away from what's the crop size to the what if demand scenarios that will play out over the next 6 to 9 months. So just what if we take use to 15.2 billion? Now all of a sudden we're talking a mildly bullish story for corn. And so as we look at the corn chart, I'm going to come back to this one here in just a second because we want to do the same thing on soybeans, okay? So remember what we've done. We've gone from 3.3 billion in total Armageddon for corn demand, right? We went in March from a 3.3 billion bushel carryout with 97 million acres at trendline yields with 0 ethanol because we shut the freaking country down. And the lowest we could push corn was 307. There is no reason on earth that we weren't well below that with those demand fundamentals. I mean, that was atrocious, right? And so what we've been saying for the last 6 to 8 weeks is let's stay careful, let's stay cautious, because what if we shut down again? Well, now I got to ask the question, what if we don't? Because when we look at the corn chart, and we said this last week, this is the report day. We said this last week that this looked like a bullish setup to us if it weren't for the report. So now when on a report day, all your technicals go out the window because you just don't know how things are going to react, right? So as we looked at this, we thought it was kind of bullish, and lo and behold, the report came out. It increased our carryout, which should have been bearish. The USDA confirmed that we have a record yield coming nationwide, and we turn around and go higher. So that either means that the storm was truly impactful or the higher yield and acreage number was already priced in. And so we saw this rally happen right off the backside of this double low, right? Here we've got, and so what this did technically, okay? We've got this price level that held and held and held right here at 325. We then broke through it with heavy volume, and almost panic-like selling. And then we just stopped. It hit the gas. It hit the brakes, right? We could not break this 320 level. When we broke back up above this level, that started to turn into a bear trap. So now all of the funds that have been short all the way down, right? Remember, they started selling here and they didn't reach their apex of their position until this area right in here. So they've really received nothing for their short position in corn. A lot of people will say, no, they were smart. They sold back in January. That's BS. They were long. They were not short corn at this time period. They didn't start selling corn until here, and they didn't reach their apex until down here. Go back and look at the Commitments of Traders report. That's what it will confirm to you. They trimmed a little bit here into the short covering rally. Then they rebuilt their position. Guys, they are underwater, and they are not finding the strength that they want. So we could easily see a little pullback here, but the tenor, the tone of the market is shifting right below our feet. So I'm not saying that there's no downside risk. What I'm saying is that the risk reward has shifted more neutral to corn. And now we need to start discounting the possibilities that maybe or maybe not this yield number is going to be accurate, and maybe or maybe not this is going to be there, and maybe or maybe not the demand number is going to improve. Because you also have to remember, phase 1 of China had a 2-year deal, right? It required them to buy a lot during this calendar year, which they have not done, but they had a higher target in next year. And the USDA does not have that full weight of that agreement baked in here. Now, who knows what's coming down that pipe, but you got to start thinking about the fact that we could move higher. So the question is this for corn, and then we're going to go to beans. with this carryout projected, with this type of analysis here, is it worth spending money on puts? That's the question for a farmer, right? What is my downside risk? I've been in the camp that owning puts makes sense because we might shut back down. We know the yield's there, the weather's been basically perfect. Today, I'm much less concerned about the downside risk. I'm not necessarily overwhelmingly bullish, so don't think we're going to $4 or anything like that. That's not what I'm saying. But I think the risk that we go back to 3 or 280 has weakened. I think that risk has lowered significantly because we're just not seeing that trend back towards a shutdown that we've been talking about. So I think we need to give it some room rather than chase the downside. You know, last night we sold the market pretty hard, and a couple of times here we've tried to reverse it and work ourselves higher. I don't know what's coming later today. We may turn around and turn weaker, but I really think below 330, our risk starts to materialize a little bit more. Anything above that is really neutral to higher, and I think that the most likely scenario after a pullback is that we challenge this 360 high just based off of the fact that this is a futures market and not a present market. So now basis, I think, is a different story. I think we can continue to see pressure in basis. You're watching the spreads turn, widen out, and I think basis could get overwhelmed as it does its job and allocates and pushes those bushels from where they are to where they need to be. Basis can do that. Futures price doesn't have to. So my call for corn is sideways to higher from here on out, unless something changes to that carryout number. All right, I beat that to death. Now let's go to beans, because beans are even more interesting to me. All right, same analysis, right? Here's our carryout numbers. This is what the USDA did to us on this last report. I keep doing the math here to figure out what percentage increase 610 to 425 is. And the number I keep coming up with every time I do it is 43.5%. The USDA increased the bean carryout by 43.5%, and the market went up 33.5 cents. So what's going on here? Because that is clearly bearish. Whichever metric you want to use, that's not a bullish deal. But we did it anyway. And the reason we increased this carryout is because the USDA confirmed that we have basically a perfect soybean crop. I mean, we're just in really, really good shape. So why in the world would the market discount that? All right, let's look at where we were on beans when this report came out, and let's look at what the price action was. Here's report day. Report day came out, and we immediately went higher. We didn't sell this market at all on what should have been basically gap and go lower action because we increased our carryout by 40%. The market either knew it and already had it priced in, or something else is materializing that maybe we're aware of and maybe we're not. Now, fast forward to Sunday night, right? See this trend line? This is January. This is when we had our trade meeting in the White House and we announced the phase 1 deal. This is this time frame. If you draw a trend line from this high to this high, that trend line has held until last Thursday when we shattered it. We came back down and tested it, and then Sunday night we gapped higher on soybeans, and we gapped right through the 200-day moving average. We haven't been above this 200-day moving average since January 23rd. That's the last close we had above that 200-day moving average. That is not an insignificant deal. Now I'm going to back the time frames out here just a little bit, because When something big like that happens, we want to get some more context, right? We've got a 43% increase in carryout, which is overwhelmingly bearish, and we gap above the freaking 200-day moving average. What the hell happened? Let's take a look at what the weekly chart looks like, right? If you back this thing out all the way back to 2016, when we had the weather scare during the summer of 2016, and we thought we were going to burn the bean crop up, we took it to $12. If you draw a trend line from there to the high in 2018, you can see that something material has shifted in the bean market. This trend line has held for 4 years, and all of a sudden we're trading back above it with gap and go higher action. To me, that is a major signal that the market is sending us that we need to be paying very close attention. So what is happening in the world that could be causing that? Well, let me go through the list. Number one, you've got what we know, right? You got China, you got American weather that might be a little bit dry. We may not be getting the rains we wanted. Maybe we got some storm damage. Our crush numbers are pretty good. So we got good demand. We got some questionable supply that maybe that USDA yield is in doubt. But what you also got going on is you've got China buying beans. You've got issues happening inside China that are making it weak, that are making their supply dwindle. Flooding, increased chicken and pork production. You got China auctioning off their state-owned reserves of corn and beans. You've got a lot of dynamic happening there. But now we are also getting ready to plant the South American crop, and you got weather issues and dryness creeping into South America. So you've got issues that are starting to develop that have changed the narrative. Now, a breakout is only a breakout if it holds, right? So I'm going to back this back to the daily chart, because when we know a couple things about the grain markets. When they break through support or resistance, we have a tendency to come back down and test it to make sure it's real. And so a bean move back down to this 200-day moving average, maybe even back down to this gap at $9, is not out of the question at all. I mean, it's only 15 cents. It can do that by 9 o'clock, right? So that very well could happen. But if it holds, then I think it is fair to say that beans are entering an uptrend, and we really don't know why that is yet. Last thing I'm going to talk about is the dollar. The dollar broke down to its lowest low since 2018 yesterday. Dollar is basically in a complete free fall. That's helpful to us, and that has put our beans at a 70-cent discount to South America. Where does 70 cents count? Well, that would be $9.85, which shockingly is this year's high. So pay attention to what beans do here, because we could easily, if we can chop through this 920, 930 level, beans could easily accelerate higher and test 950 or maybe even more, depending on what weather does and depending on how traders digest that data. So to me, the prudent play is to be very, very patient as a farmer. We don't want to be reckless. So we've been hedged down here. I think we hold those and we just don't worry about it. If we get some sort of exhaustion or some sort of reversal, we'll move those hedges up. But otherwise, we want to keep our upside wide open, because the overall tenor of the market is starting to shift to maybe a little bit, I don't even want to say more bullish tone, but a less bearish tone than what we've had, which should take a lot of the bottom or the downside out of the market. So one more minute. Wheat, same thing with wheat. See this trend line that's held since April? We finally have broken it. And as long as it holds, wheat could shift to a sideways to a slightly bullish tilt. And if corn or beans start to move, I would expect wheat to follow it as well. All right, that's a lot of information. I hope it was helpful. Hope it challenged some of the thought process. Call me. Please let me know where I'm struggling, and we will talk to you next week. Have a great day.